Welcome back to Talk Tickers. It is Saturday morning, February 21st, 2026. I am your host, and as always, I am joined across the desk by the voice of reason. You know, the person who actually reads the footnotes while I'm just looking at the pictures. Welcome back to the deep dive.
Yeah, it is good to be here. And honestly, for today's deep dive, the footnotes are exactly where the entire story was hiding.
You know, there is an old saying on trading desks, price is truth. The idea is that the ticker tape never lies. But if you were watching the tape yesterday, Friday the 20th, the truth looked, well, it looked a little bit schizophrenic. It was a tale of two markets, wasn't it?
It absolutely was. It was a psychological thriller played out in real time. We are talking, of course, about AngloGold Ashanti, ticker symbol AU.
AU, literally the chemical symbol for gold. You really cannot get a better ticker than that. It is the OG.
It is the classic. But if you tuned in at, say, 8 in the morning Eastern yesterday, right when the earnings print hit the wires, you would have thought this company was in serious, serious trouble.
Let's set the scene for the listener. It is pre-market. The coffee is still brewing. The press release drops. The algorithms, you know, those high-speed trading bots that basically run the world now, they scrape the headline. And what exactly do they see?
They see a miss. The consensus expectation for earnings per share, what the street really thought they would earn, was $1.90. The actual GAAP EPS number came in at $1.68.
22-cent miss. I mean, in this environment, usually you miss by 20 cents, you get taken out back and shot.
Exactly. And the stock gaped down immediately. In the pre-market, it was down about 1.2%, trading right around $106.32. The algo saw that word miss and just
hit sell.
Hit sell. It was a pure knee-jerk reaction to a headline number.
But then the humans showed up.
Right. The opening bell rings at 9:30. Actual portfolio managers, analysts, deep value investors, they start actually reading the report. They get past that headline EPS number, they dig into the cash flow statement, and they see something else entirely.
And that is where the magic happened. A complete 180-degree turn, a massive intraday reversal. By the time the closing bell rang, AngloGold hadn't just recovered the losses, it was soaring. It finished the day up 6.27% at $114.38.
And look at the volume, too. Nearly 5 million shares traded. That is compared to a daily average of maybe 1.7 million prior to this. That is serious institutional money moving in.
That is a high conviction move. That is the market saying, wait a minute, we were completely wrong at 8 in the morning. So our mission today is to figure out what the humans saw that the algorithms completely missed. Because it seems like market fell in love with two very specific narratives.
Precisely. They looked past the earnings, missed the noise, if you will, and fell in love with the signal. And the signal is twofold. One, this company is transformed into a literal cash machine. And two, they have a massive future in Nevada that is becoming very real very fast.
This isn't just a gold mining story anymore. This is a capital return story. And frankly, it is a story about a company that has so much money, they quite literally do not know what to do with it. So let's crack this open. Let's start with the financials. What was the noise that tripped everyone up initially?
The noise was the EPS miss. But to understand why that didn't matter, you have to look at why they missed. Revenue actually beat expectations, $3.07 billion versus the consensus of $2.99 billion. So they sold plenty of gold. The miss came entirely from costs.
Which we will definitely get into. But usually, higher costs crush a mining stock. Why did the market give them a pass here?
Because of the free cash flow, FCF. This is the heartbeat of any mining company. It is the cash left over after you pay all your operating expenses and all your capital expenditures just to keep the mines running. For the full year 2025, AngloGold generated a record $2.9 billion in free cash flow.
$2.9 billion. I want to just pause on that number for you listening.
Yeah.
In the world of tech giants, we get completely numb to billions. But for a gold miner, contextualize that leverage for us.
It is staggering. To put it in perspective, that is up nearly 3 times from the previous year.
They tripled their cash generation.
Essentially, yes.
Wow.
And adjusted EBITDA was $6.3 billion, which is up 129% year over year. But the number that really tells the story of the transformation is the balance sheet itself. They started the year, the end of 24, with $567 million in net debt. They ended 2025 with $879 million in net cash.
So they paid off all the debt and stacked nearly $1 billion in the checking account.
Exactly. They have total liquidity standing at about $4.4 billion right now. They are absolutely swimming in liquidity.
Now, here's the thing about mining companies, and I say this with love because I really do love the sector. But usually when a miner has $1 billion in the bank, the CEO starts to get an itch.
The empire building itch.
Right, the bunker mentality. They think, well, gold is high right now, but it might crash tomorrow, so let's hoard the cash. Or worse, let's go buy a terrible asset for a massive premium just because we feel rich. It has historically been a sector of terrible capital allocators.
You are not wrong. That is the historical playbook of the industry. Buying high and selling low. But AngloGold Ashanti just proved they are playing a totally different game. They looked at that massive pile of cash, and instead of buying a rival or building a new corporate palace, they dropped what you called the dividend bomb.
It was an absolute shocker. Management declared a massive Q4 interim dividend, 173 cents per share.
That is roughly $875 million, leaving the company accounts and going directly into shareholder pockets in a single quarter.
That is nearly $1 billion just handed back to the owners.
Total dividends for 2025 came to 357 cents per share. That is about $1.8 billion total for the year.
So let's just do the napkin math here together. They generated $2.9 billion in free cash flow, and they paid out $1.8 billion of it.
That is a payout ratio that just screams confidence. They are not hoarding the cash from these high gold prices. They are flushing it to shareholders.
But I want to really deep dive into how they got to that specific number, because it wasn't just a random, hey, here is some cash, guys. There was a specific mechanism, and then there was a surprise on top of it, right?
Correct. They have a very disciplined policy framework. The base policy is a quarterly payout of 12.5 cents. That is the keep the lights on dividend. Then they have an annual true-up.
Explain the true-up for the listener who maybe isn't a CFO.
So the policy states they will top up the dividend annually to reach 50% of free cash flow before growth capital. So at the end of the year, they look at the total pile of cash generated, they take half of it, subtract what they already paid in the quarterly checks, and send the rest as a final payment.
Okay, that is disciplined. That is a rule-based approach. We make $1, you get 50 cents.
But then came the surprise. The board looked at the balance sheet, looked at the 50% calculation, and basically said, we still have way too much money.
Too much money. I mean, that is a high-class problem to have.
It really is. So management added an additional $350 million discretionary payment right on top of the policy.
Why, though? Why not just keep it for a rainy day?
This signals that even with heavy CapEx planned for Nevada, which we will get into, the balance sheet is so clean they literally have too much cash to be efficient. It effectively targets zero net cash at year-end 2025. They don't want the cash drag on their returns.
It changes the thesis on the stock entirely. It is no longer just a gold proxy or a speculative mining play. It is a yield vehicle. It is a cash printing press.
And that is exactly why the stock rallied over 6%. You buy the stock, you get the cash.
Now, obviously, this cash glut is driven by one big variable, and that is the price of gold itself. We cannot ignore the macro environment here.
The macro tailwind is undeniable. The average received price for AngloGold in FY25 was $3,468 per ounce.
$3,468. I remember when we were popping champagne at 2000.
Right, it is a 45% increase year over year. That is a fundamental shift in the economics of mining. When you are selling your product for nearly $3,500 and your costs are, well, let's actually talk about the costs.
Yes, let's talk about the costs, because this goes back to that EPS miss at 8 in the morning. The headline number missed because costs were higher. Inflation hasn't just magically gone away.
No, it hasn't. But there is a nuance here that is absolutely critical for you to understand if you are investing in this space. It is the difference between bad costs and sticky costs.
Sticky costs. Break that down for us.
Managed cash costs were $1,252 per ounce, which is up about 5%. All-in sustaining costs, or AISC, were $1,751 per ounce. Now, on paper, that looks like a big jump. But management noted that a huge chunk of that cost increase is actually royalties.
Because governments want their cut of the pie.
Exactly. When gold is at $3,400, your royalty bill to the government of Ghana or Tanzania or Argentina goes up automatically. It is percentage-based. You cannot control that. It's effectively a success tax.
So high royalties are actually a symptom of high revenue.
Correct. If your royalty costs are up, it means your top line is exploding. That is a problem you want to have. The EPS miss likely came from these royalty costs being slightly higher than the analysts modeled. When gold runs up that fast, the models break.
What about the other half, though? The operational costs, the fuel, the labor, the giant tires for the haul trucks.
That is the operational inflation. But here's the stat that stood out to me from the call, and I think the market really appreciated this once they dug in past the headline. AngloGold noted they are the only major mining company to keep cash costs flat in real terms since 2021.
Meaning, if you strip out the general CPI inflation rate over the last few years, their actual operational efficiency hasn't degraded at all.
Exactly. They have completely offset the underlying inflation with efficiency gains. They're running faster just to stay in the same place cost-wise, but everyone else in the industry is falling behind.
That is a critical distinction. It is easy to look at a rising cost curve and think, oh, management has lost control of the operations. But if it is royalties and basic CPI, and they are holding the line on real terms efficiency, that is a totally different story.
And the market eventually figured that out by the end of the trading day.
Yeah.
You happily accept the cost inflation because you want access to that $3,468 gold price. The margin expansion is just too huge to ignore.
Let's pivot to the operations then. The actual digging of holes in the ground. You mentioned efficiency. One thing the CEO, Alberto Calderon, led with was safety. Now, usually on these earnings calls, the safety slide is the eat your vegetables part of the presentation. Everyone nods politely, but they are checking their email, waiting for the financials to pop up. But Calderon made a really interesting connection here.
He did. It was quite meta, actually. He mentioned he was listening to an AI podcast that analyzed their results, much like we are doing right now, and he liked that they caught the link between safety and operational excellence.
The robots are listening to the robots.
Indeed. But the core point really stands. They hit a record low injury rate, a frequency of just 0.97. Calderon's philosophy is simple. Safe mines have higher uptime. If you aren't hurting people, you aren't shutting down the mine for investigations. You have less unplanned maintenance.
It is not just altruism, it is just good business. If the ambulance isn't running, the haul trucks are running.
Exactly. Safety is a leading indicator for that massive free cash flow we just talked about.
Let's look at the assets actually driving this cash flow. We have to talk about Sukari in Egypt. This was the big acquisition recently. They consolidated this massive mine. How is it performing?
Sukari is a beast. This was the first full year of consolidation, and honestly, it is a Tier-1 asset by every single measure.
Give me the numbers. Why is it Tier-1?
Management highlighted that in just the first year, Sukari generated almost one-third of its net acquisition cost in pure cash flow.
Wait, hold on a second. They bought the mine, and in 12 months, it paid back 33% of the purchase price?
Correct. When you factor in the cash flow it generated in year one, the payback period on this thing is incredibly short.
It is like buying a rental property and having the first year's rent cover a third of your mortgage. You just do not see that in this industry.
You really don't. And integration is totally complete. Now they are looking to expand. They want to expand the underground operations from 1.2 million tons to 2.3 million tons of ore.
Nearly doubling the underground throughput.
Yes. This is the absolute cash cow of the portfolio right now.
Moving west across the continent to Ghana, Oboassi. This is a mine with a very long, very complicated history. It was shut down, it was redeveloped, it had severe safety issues in the past, it was the problem child for a long time. How is the turnaround kid doing today?
Oboassi is finally behaving beautifully. Production was 266,000 ounces, which is up 20%.
That is solid growth. But how? What actually changed underground?
It is the mining method.
Hmm.
They have implemented a specific technique called underhand drift and fill.
Underhand drift and fill. That sounds like a Mario Kart maneuver. Unpack that for the non-geologist listener.
It does sound like that. Okay, picture the ore body underground. Oboassi has incredibly high-cut gold, but the rock around it is notoriously unstable. It is crumbly. If you just go in and blast a massive cavern, the roof is going to cave in on you.
Not ideal for safety or production.
No. So in underhand drift and fill, you start at the top of the ore body, you mine a horizontal slice, that is the drift. Then you fill that empty tunnel with a mixture of cement and waste rock. That hardens into a solid concrete floor.
Okay, I am with you.
Then you go underneath that concrete floor and mine the next slice down. So instead of having a crumbly rock roof over your head, you have a solid concrete roof that you literally just built yourself.
That is brilliant, actually. So you are building your own safety shield as you work your way down the deposit.
Exactly. It is a slower process than just blasting everything in sight, but it is infinitely safer and allows for very high recovery of that valuable gold. And the method is clearly working. They're aiming for over 300,000 ounces in 2026.
And what about the margin there?
Calderon threw out a great stat on the call. Cash flow per ounce at Oboassi was around $1,300 per ounce. He noted that it's actually double the cash flow per ounce at Kibali, which is their other big operation. So Oboassi is becoming a serious high-margin engine.
That is a massive turnaround for an asset that gave them so many headaches just a few years ago. Oh, quickly, before we leave Africa, you mentioned Kibali.
Right, Kibali. They're finally investing heavily in growth there. $70 million allocated to expand that footprint.
Excellent. Now let's hop over the Atlantic to Argentina. Cerro Vanguardia or CVSA?
Ah, yes, the asset they tried to sell.
They really did put a for sale sign on the front lawn of this mine, didn't they?
They did. Management admitted it openly on the call. But then two major things happened. Gold went to $3,400 and silver went on an absolute tear. CVSA produced 3.7 million ounces of silver this year.
It is practically a silver mine disguised as a gold mine at this point.
Essentially. And secondly, the political environment in Argentina improved significantly. They mentioned improved government relations are finally allowing cash repatriation.
That has always been the fundamental issue in Argentina. It is a great place to mine, but can you actually get the dollars out of a country?
Exactly. For years, money went into Argentina and never came out.
Yeah.
But now they can repatriate cash easily. So with the high prices and the cash flowing freely, they are very happy to keep it. It is a pure cash cow now.
It is like breaking up with someone, but then they win the lottery, so you quietly decide to stay together.
And you are very happy you did.
All right. We have covered the cash, the dividend, and the current operations. But here is the thing. The reason the stock reversed and finished up over 6% yesterday wasn't just about today's cash. Markets are forward-looking machines. The real excitement on that call was about the future. It was about the Nevada pivot.
This is the narrative changer.
Yeah.
This is what fundamentally turns AngloGold from an African dividend yielder into a North American growth stock.
We are talking about the Arthur Gold Project. Formerly, we knew this as the separate Merlin and Silicon deposits in Nevada. Now it is one big consolidated district called Arthur.
And management is not being shy here at all. They are framing this as the greenfield discovery of the century in the U.S.
That is enormous talk. Discovery of the century. Usually when a mining executive uses superlatives like that, I instinctively grab my wallet and run the other way. Do the actual numbers back that up?
Let's look at the specs released in this update. Initial reserve stands at 4.9 million ounces. That is probable reserve.
That is a very healthy starting number.
It is. But that is just the reserve. The resource base, the gold they know is there but haven't fully drilled out for mine planning yet, is significantly larger. They are targeting a 20 million ounce total resource eventually.
20 million ounces, that is a generational asset. That is a mine your grandkids could work at.
The initial mine life is stated at about 9 years. But everyone on the call, including management, knows that is highly conservative. In reality, with a resource base that size, this is likely a multi-decade operation.
And the production profile, how much gold per year?
An average of 500,000 ounces per year. But in the early years of the mine plan, they're peaking near 800,000 ounces annually.
800,000 ounces a year from a single asset. That moves the needle, even for a major like Anglo.
It absolutely does. But here is the most important part of the entire Nevada story. It is not just the size, it is the simple advantage. And this is where we have to talk about geology, because if you don't understand the rock, you don't understand the valuation.
Okay, lay it on us. Why is Arthur's rock so special compared to the rest of Nevada?
It is oxide ore.
Okay, pause. I see oxide in this report, and I see refractory in other reports from companies like Barrick or Newmont who operate in Nevada. To the average investor, that just sounds like different flavors of dirt. Why does it matter so much?
It matters because it completely dictates your profit margin and your technical risk profile. Think of gold ore like a chocolate chip cookie.
I am always down for a food analogy. Go on.
In an oxide deposit, the gold is like the chocolate chips. The rock around it has weathered away or oxidized over millions of years near the surface. The gold is free. It is just sitting there. You crush the cookie, you sprinkle a weak cyanide solution over it on a leach pad, and the gold washes right out. It is cheap, it is simple, and it uses standard, proven equipment.
Okay, simple is good. Carbon and leach, heap leach, basic stuff.
Now compare that to most other big, deep deposits in Nevada. They are refractory. In that case, the gold isn't a distinct chocolate chip. The gold is chemically locked inside the molecular structure of the rock itself, usually trapped in sulfide minerals. You cannot just wash it out.
How do you get it out?
You have to cook it.
Yeah.
You need massive, highly pressurized vessels called autoclaves or giant industrial roasters. You have to heat the rock to thousands of degrees or use immense pressure just to break the chemical bonds and release the gold before you can even start the cyanide process.
That sounds incredibly expensive.
It is astronomically expensive. It is energy intensive. It requires complex air quality permits. The autoclaves break down constantly because they are highly corrosive environments. It is effectively a giant science project.
So refractory is a science project. Oxide is just a dirt-moving project.
Exactly. And Arthur is a massive oxide deposit. The CEO specifically said on the call, it is as simple as it gets. No autoclaves, no roasting, no double refractory headaches that are common in Nevada.
And it is an open pit mine, right? They aren't going underground.
Large-scale open pit. They're talking about using massive electric rope shovels with 60 cubic meter buckets. It's just hyper-efficient stripping and moving of rock.
Simple means lower technical risk, and usually that translates to lower operating costs.
Correct. And this is the number that should genuinely make your jaw drop. The cash costs for Arthur are currently estimated at roughly $780 per ounce.
$780 cash cost. And they're selling it for over $3,400 today.
That margin is absurd. Even the all-in sustaining cost, the ANSC, is estimated at around $950 per ounce. So you are making a $2,500 margin on every single ounce at spot prices.
That perfectly explains the valuation gap and why the stock surged. If I am an investor, I'm paying a premium for simple. I do not want to worry about an autoclave exploding in Nevada.
Precisely. But there is a catch. There is always a catch in mining.
Of course there is. What is the catch?
The price tag to build it. The initial capex is estimated at $3.6 billion.
Ouch. $3.6 billion. That is a very serious check to write, even for them.
It is pure sticker shock. And that is partly why the capex guidance for the next few years across the whole company is rising. But when you run the math on those margins we just discussed, the returns are phenomenal. They quoted an IRR, an internal rate of return, well north of 20% at conservative long-term prices, significantly higher at the $300-400 spot price.
So it is expensive to build, but it is a literal money printer once it is turned on. What is the timeline here? When do we actually see the first gold bar poured at Arthur?
Patience is definitely required. The feasibility study starts in Q2 of this year, 2026. The permitting process, specifically the NEPA process, starts in Q1 2027.
NEPA, the National Environmental Policy Act, that is the gauntlet. That is usually where mining projects go to die, or at least stall for a decade in the U.S.
It is, but they are using a fast-track process.
Mm-hmm.
They have support because it is viewed as a strategic project. They expect the record of decision, the ultimate green light by the end of the decade, so actual production in the early 2030s.
That feels like a very long way away for a market that trades on quarterly earnings.
It is. But the market is starting to price in the probability of that future cash flow right now. That is why the stock re-rated. They see the path is clear.
One potential hurdle that always comes up in Nevada, and it was mentioned on the call, is water. It is a desert. There is always local opposition to water use.
There is always opposition regarding water rights in Nevada. It is, frankly, the most precious resource there, more than the gold itself. Management acknowledged it openly, but they claim they have constructive talks ongoing and highly sophisticated hydrogeological models. They seem confident they can navigate it, but if you're an investor, that is the one primary risk you need to monitor.
Okay, so Arthur is the dream, but we have to get there. Let's look at the bridge to the 2030s, the guidance for 2026. What are they telling us about the next 12 months?
For 2026, they are guiding total production of 2.82 to 3.17 million ounces. So stable to slightly up from 2025.
But the costs are stepping up again.
They are. They're guiding managed cash costs of $1,335 to $1,455 per ounce.
That is a noticeable jump from the $12,252 we just saw in 2025.
It is. And again, management was very transparent about why. Half of that jump is royalties, which are linked to the gold price staying high. The other half is sticky inflation and foreign exchange impacts.
So the market just has to get comfortable with $1,400 cash costs as the new baseline normal.
Yes. But again, do the simple math. $3,400 price minus $1,400 cost is still a massive $2,000 margin. As long as gold holds above $3,000, nobody really cares about a little cost creep.
And on the spending side, the capex is going up to build the bridge.
Significantly. Sustaining capital is right around $1 billion, But growth capital, the non-sustaining spend, is jumping to around $785 to $835 million.
Where exactly is that growth money going this year?
Three main buckets. One, obviously Nevada. They're spending heavily on Arthur and the smaller North Bullfrog project nearby. Two, Sukari waste stripping. They have to move a lot of dirt to expose that new ore body. And three, tailings, TSFs across the entire portfolio.
Tailing storage facilities, the unsexy but completely essential part of mining. You have to store the crushed waste rock safely.
Exactly. And frankly, after some of the catastrophic disasters the industry has seen in the last decade, dams collapsing in Brazil and elsewhere, investors should be thrilled they're spending heavily on TSFs. You do not want to skimp on that.
So, heavy spend. But it is all funded by that record cash flow.
They are funding the sustaining capex, the massive growth capex, and still paying a $1.8 billion dividend. That is the sheer beauty of the current gold price environment for a well-run company.
What about growth outside of Arthur? Are they looking to buy anyone? The market loves M&A speculation, and with $4.4 billion in liquidity, they could easily buy a mid-tier producer tomorrow morning.
The CEO, Alberto Calderon, poured a huge bucket of cold water on big M&A. His stance was very clear. He said it is hard to pay a premium and still add value.
That is executive code for everything out there is way too expensive right now.
It is. He implies that if he buys a junior miner today, he has to pay a 30 or 40% premium to the share price. That instantly destroys shareholder value. He doesn't want to overpay. Instead, he pointed to an internal pipeline.
What does that internal pipeline look like?
He says they have 10 to 15% production growth available just from optimizing their existing assets over the next 3 years. That is Oboassi ramp-up, Sukari underground, Geita open pit, Sukari. He has a VP of growth dedicated purely to squeezing more ounces out of the mines they already own.
That is the low-hanging fruit. It is always cheaper to expand a mine you own than to buy a mine someone else owns.
Exactly. They did make one small external move, though, a strategic investment.
Right. They took a stake in Thesis Gold, the Lawless Ranch project.
Yes, it is just a toe in the water, keeping some exposure to junior exploration upside without buying the whole company and taking on the operational headache.
So if we pull back, the overarching strategic storyline here is a transition.
It is a massive transition. They are moving from being seen by the market as a pure dividend yielder with African geopolitical risk to a company with a Tier 1 North American growth future.
That Tier 1 label is starting to stick to Arthur. And when you get a Tier 1 label in the US, your multiple naturally expands.
That is the holy grail for these companies, the North American premium. If they execute on Arthur, AngloGold shouldn't trade at 4 or 5 times cash flow like a typical African miner. It should trade at 8 or 10 times like an Agnico Eagle.
And that valuation gap is the exact opportunity for investors today. Which brings us to our absolute favorite segment of the deep dive. The part where we take off the sensible, prudent analyst hats, pour a glass of something strong, and put on the reckless hedge fund manager hats.
Yes, the outrageous but plausible segment.
Now, listener, this is not financial advice. We are just voices in your headphones. Do your own diligence. Do not trade based on what we say here. We are speculating purely for entertainment. If you lose your shirt on this, do not email us.
Strictly entertainment.
Okay, expert, you have seen the numbers. You understand the geology deeply. Give me the trade. What is the play based on this earnings call?
I call this trade the Arthur carve-out ARB.
I love the sound of that. Walk me through the mechanics.
The core thesis is this. The market is currently valuing AngloGold Ashanti as an African and emerging market producer. It has a discounted multiple because of geopolitical risk. People worry about tax regime changes in Ghana or rules in Argentina. The market basically treats the Nevada assets as a free option, a nice bonus, but not the core value driver yet.
Okay, so the stock is fundamentally cheap right now because of where the current cash flowing mines are located.
Correct. But Arthur is being revealed right now as a simple, massive oxide beast. As we move through 2026, the feasibility study comes out, the permitting kicks off, and that Tier 1 quality becomes completely undeniable to Wall Street.
So what is leg one of the trade?
Leg one is long. You go aggressively long AngloGold. You could do it with the equity. Or if you're feeling spicy, deep out of the money calls for January 2027. The specific catalyst you are playing for is the filing of the technical report summary on March 26th of this year.
Why that specific date in March?
Because that document is going to put the black and white numbers, the geology, the metallurgy, the strip ratio in front of every single analyst. As soon as they update their Excel models with that $780 cash cost we talked about, the re-rate happens instantly. You are front-running the spreadsheets.
I like it. But every good trade needs a hedge. What is leg two?
Leg two is the fun part. You short a basket of Nevada peer companies who are currently struggling with refractory ore.
Oh, that is mean.
It is capitalism. Capital is finite. If I am a massive institutional generalist investor and I decide I want Nevada gold exposure, why on earth would I put my money into a company dealing with broken autoclaves, massive energy bills, and huge technical risk when I can just buy Anglo's simple oxide story?
You would. You would take the path of least resistance.
Exactly. Arthur is going to organically suck investment capital away from the high-cost technical risk projects in the region. So you go along the simple geology and short the complex geology. It is quite literally a geology arbitrage.
And what is the outrageous kicker to this thesis? What is the end game you see?
The end game hits around 2030. AngloGold management realizes that the African assets and the American assets act like oil and water in the valuation model. The African assets consistently drag down the American multiple. So they do the obvious thing. They spin off the Nevada assets into a completely separate U.S.-listed entity. Let's call it Anglo-Americas.
Anglo-Americas.
That new company immediately trades at a 2x multiple to the parent company because it has zero geopolitical risk. If you own the Anglo stock now, you are front-running that inevitable split. You basically get the spin-off shares for free.
That is entirely plausible, actually. It is the classic conglomerate unlock playbook.
It is the standard playbook. And if they actually execute on building Arthur, it is almost inevitable.
Fascinating stuff. The Arthur carve-out arb. Remember, folks, not financial advice, but definitely some rich food for thought as you look at your portfolio this weekend.
Absolutely.
All right, let's wrap this up. We have covered a massive amount of ground today. Give us the quick recap for the listener who is just tuning in for the summary while they are pulling into the driveway.
4 key takeaways to remember. 1, record free cash flow of $2.9 billion. The core cash machine is running incredibly hot. 2, a massive dividend. $1.8 billion returned to shareholders in 2025 alone. They are not hoarding cash. They are paying you to wait.
Number 3.
Nevada is real. The Arthur project is huge, with a 4.9 million ounce reserve. It is simple oxide ore, and it is moving forward fast. This is the future growth engine that totally changes the valuation math.
And the final takeaway.
Margins, yes, costs are up. $1,400 per ounce operating costs are the new reality you have to accept. But with gold sitting above $3,400, the profit margins are still historically unbelievably high.
So the volatility we saw on the gap down at the open, followed by the massive rally into the close, that was just the market's initial confusion clearing up in real time.
It was. The market collectively realized you willingly buy the cost inflation because it is the only way to get your hands on that cash printing press.
And that is a very powerful narrative. We will definitely be watching the tape on Monday to see if that momentum carries forward. That is it for this deep dive into AngloGold Ashanti. I want to leave you with one final thought to mull over. If Anglo actually manages to spin out those Nevada assets by 2030, does the African remnant company become the ultimate deep value takeover target for a Chinese state-owned miner? Think about that geopolitical chess game.
Keep watching the tape.
See you next quarter.